Hi, this is Dr. M. Prakash. Welcome to my show. Today is January 22nd, and we'll talk about the market and also covered options, like I had mentioned last week. Okay, so let me start sharing my presentation, and this is my share, and you should be able to see my charts. Okay, first thing first, let me show you the disclaimer chart, which just says that this is an educational or informational presentation, and the final decision on what stocks you buy or what options you buy is your own decision. Okay. All right. So, like always, let's look at how the market did last week. So, it was on a roller coaster, right? So, initially, it went down considerably. The reason it went down was because the retail sales report was bad, and the market said, oh, the recession is coming, so I need to sell stocks. That was the reason. Then the Fed officials, the federal bank officials, they were also giving hawkish comments. They were saying that we'll keep raising the interest rate beyond 5% and we'll keep it there for a long time because we are not convinced the inflation is coming down, right? But later on, Netflix reported their earnings, and what happened? Netflix surprised the market in terms of subscriber growth. They added more subscribers than the market was thinking. So the result, the media stocks started going up. And then after that, Google announced big layoffs, Microsoft announced big layoffs, and the market interpreted those layoffs in a different way. Instead of thinking that these companies were in trouble, they said they're cutting costs, so their earnings will improve. So it's a good time to buy tech stocks, number one. Number two, as more people are laid off, there is competition for jobs. So wage pressure goes down, which is good for inflation. So the Federal Reserve Bank will not increase the interest rate too much. So they took that as a very positive thing. And so the stock market started going up, led by the tech rally. But even then, even with all this going on for the whole week, the market was down a little bit, right? Okay. So, the funny thing about this market is every time it has tried to go up, it hits around 4,000, 4,050, and that is almost like a ceiling, and it starts coming down. The market is going up and down, and it presents you opportunities to do what I term as covered options, covered put options, right? That's a way of making money, an income stream, without even owning the stock. So let me explain that deal, okay? All right, so we're going to discuss these covered put options. So what happens in a covered put option? You decide to sell a covered put option. So you can do that even if you don't own the underlying stock, okay? So let me give you an example. You have a company X and the stock is trading, let's say 105, and you say, I'm going to sell a put option, a covered put option at 100, and it expires in 2 weeks, let's say. So what that means is, should the price go to 100, within the 2-week period, you are obliged to buy the stock, which means you need to have at least $10,000 sitting there to execute this covered put option. So that's the only constraint there. If you don't have access to that type of cash or a loan, you won't be able to do this type of covered put option. So for selling, when you sell it, somebody buys that covered put option from you, and they pay you a premium that could be like $2 or $3 or $5. So one option, is 100 stocks. So if it's like $3, you get $300 immediately. Okay, and should it stay above your strike price, if the stock price stays above your strike price, you keep that $300, and the option expires, and then it's a done deal. So you just got $300 because you made a promise, you made a commitment that you would buy the stock in case it went to $100. Understand? So that's a good thing. But if it goes below $100, let's say it reaches $95. So now you're buying this stock at $100, where if you had really waited and kind of watched it, then you could have bought it for $95. So theoretically, you lost some money there, right? So but it's a good strategy to buy stocks you would like to own, good stocks, right? So you don't play this type of trade on some, company that could be in trouble, not having a good balance sheet, that type of thing. Okay. And also you may play this strategy because you really want to own the stock. Okay. So I'll give you an example, an actual trade I made a few weeks ago, right? So let me go and show you that. Okay. So the one I did was a Microsoft, and I'll walk you through that. So let's look at Microsoft, right? So this is the price of Microsoft for the last 6 months. You can see it here. And it has been going down. Of course, it goes up and down, but the general trend is downwards. And I've also added two indicators here. One is a 200-day moving average. The other one is a 50-day moving average. So moving average is the price of the stock average over the past few days, like 200 days in the first curve and 50 days in the second curve. Now, so it was very close to 200-day average here, and then it started going down. It went below 50-day moving average, and it was there for a long time, tried to get out of it, could not really cross the 200-day moving average, again started going back. Now, so basically it has been hitting, new lows here, right? And in this period. So something happened on January 5th. An analyst came and he said, Microsoft is not a good stock right now. You should really sell it. He downgraded that stock, and the market got really worried. Traders really got worried, and they started dumping the stock. So it lost almost 10 points in a single day, and it hit almost $221. And then it recovered actually for in a couple of days it recovered, and then in 2 weeks it recovered, and then it hit $240 on Friday. Okay, so I made a trade. How did I make? When the analyst downgraded the stock, I said, let me go and sell a put option. So I sold a put option for $217. It was below the low point on that day, which was 221. And I also said, I want the expiration date to be January 20th. So which is below what was going on that day. For that trade, I received $300 per put. Okay. Now, after I made the trade, the Microsoft stock never went below 221. So 271 was never hit. My strike price was never hit. On Friday, the option expired, and I kept that $300 I had made. Okay. So this is the way you can generate some extra income. Now, it should have, let's say it had come to 215, then I'd be obligated to buy, Microsoft stocks. But since Microsoft is a good stock, it's something I would like to own in my portfolio, I didn't see that it was a very risky thing for me to do. Now, there's also something else you can do. So you buy the stock at a low price. Let's say you get assigned, when you have to buy the stock, it's called assignment. Then you can wait for a few days. These stocks go up and down. So in a couple of more weeks, they come back and they're above, and then you can just get out of it and make some more money by trading, by that capital gain. Okay. So that's a way you can generate some extra income for yourself. Okay. So that's a strategy. So remember, let me go back to this chart and show you something else. So in this chart, there are two other indicators you should concentrate on. One is the volume. And as you can see, the volume here, there are a lot of red days, which means the Microsoft stock has been under pressure for the last few months, right? But even more interesting is this RSI chart, this RSI line, right? This is called Relative Strength Index, which is a comparison of how many people want to buy versus how many people want to sell, right? So if RSI is closer to 20, there are lots of sellers. If the RSI is closer to 80, there are a lot of buyers, right? It's usually between, it has to be between 0 and 100. Now, a good time to execute a and put option, sell a put option is when RSI is close to 20, right? So in this case, right now it's around 53, but on the day I executed, it was around 30 or so, right? So that's something you can use, whether you want to have a put option, sell a put option or not, okay? All right. So what are the things you want to watch when you sell a put option? You want to make sure that it's a stock you won't mind owning. Should it be assigned for you? It's a stock that you would like to have in your portfolio. Otherwise, you should not do this. Okay. Now, you should always sell it when it is comfortably below the 50-day moving average and the RSI is at least below 40. If it's above 40, you have to be a little careful. Okay. If you end getting assigned, like I told you, you can always trade out later for a profit. You can wait out for a few weeks. The stocks always go up and down and they go up above what you had paid for. Get out of it, okay? But watch for specific events also. If the expiration day is coming after the earnings report, that's not a good time to execute a uh, put option sale in general. But some people take risk. I have also taken risk of that type, and it has worked out, right? And also look at other economic indicators, like the retail sales support. The retail sales report that came out a few days ago that affected a lot of retail stocks like Target and others. So if you knew that was coming, then you should not be doing put options in that type of stock. It can go up or down, so you have to be careful there. So in general, you sell a put option when the market or stock is low, right? And there's a lot of bearishness, right? People are selling stocks, they're trying to get out of the stock. That's when you have to do that. Okay, so this is a real example I walked you through. So let's look at a put option you can sell today, which I think, is something that you can do and has a lower risk. Nothing is risk-free, right? It has a lower risk. And the one I'm talking about is CVS. You can see this is the CVS stock, which has been going down a lot for the last few weeks. Why is it going down? It's a combination of several things, right? There's a retail, it has these pharmacies all over the country, but it also has the Aetna insurance company. So it's in healthcare management also. Now, they're also thinking of buying one more insurance company. I think it's called Oak Street Health. And people are worried about it. The market is worried about it because if they were to buy it, they'll take more loans. More loans on your balance sheet is usually not good. So that's why there is a lot of downward pressure, right? The traders are selling it. In fact, on Friday, it reached 87, which is very, very close to 52-week low, right? So when you see a chance like that, you may want to take a look, right? And also look at the RSI here. The RSI here is 25. So it's very close to the 20 as I told you. And it's way below it's both 50-day and 200-day moving average. So it looks like it is a stock right for selling put options, right? And what is the premium you get? Now, the premium you get may not be as high as you would get in, say, Microsoft or Apple, or one of those stocks. So here is one. I looked at the, expiring on February 10th, let's say you set a put option, and the quotes on Friday were, let's say you want to strike at 85. So it's below where it is today, where it was on Friday, 87, right? So the bet you're making is, it's not going to hit 85. It's already so low. And then eventually bounces back. And the premium you'll get for that is 1.4, means $140. So the premium is not very high, but it's more than you would get as a dividend if you own the stock, in a quarter, right? So that's not bad, right? So let's say somebody executed this, or you executed this. So expiring on February 10, and the strike is 85, right? So let's go and see what happens to that. So the current price is 87. and you're selling the covered put at 85, expiring on February 10th, and you look at the 52-week low, it's just below 87, and then you sell it, and then you get $140 in premium, right? Now, what are the risks to this strategy if you were to do this? As I said, you have to watch out for the dates here. The Q4 earnings comes on February 8th, which is before the expiration date. So there may be some volatility there. But the mood of the market about CVS is very bad right now. You saw the RSI is being 20. Even if they made a little bit better earnings than what they are expecting, or if their comments were positive, then the stock will go up, right? Now, the other risk is this rumor about buying the Oak Street Health, that may come true. Then they'll have to take this $10 billion loan. Their balance sheet gets bad. So then the stock may go down. Now, in which case you'll have to buy the stock, right? But as we discussed, CVS is a good holding, medium term to long term. So from that perspective, it's not that much of a risk. Now, what's the probability that it may hit around 85 or 85 or below by February 10th? I did some modeling, and the modeling suggested that it may be less than 40%. So it's not really a big risk, but there is some risk. Okay. So this is something that you can do. Okay. All right. So that's it for this week. Okay. So next week we'll come back, and maybe I can suggest a few more option trades, and I can also suggest a few more stocks you can buy. Okay. All right. So that should end it for this week. And so one request, I know that a lot of you are watching, but you're not subscribing to my channel. Please subscribe. I'll appreciate that. Okay. Thank you. See you next week. All right. Bye.